Right, I guess we'll begin. So, good morning, everyone. I'm Caitlin. These are my colleagues, Caroline and Nick. And today we'd like to talk to you about Mr. LaRue. And first of all, we'd like to congratulate him on his incredible career in the music industry, having founded his own business. It's obviously very impressive, and we'd like to congratulate him on his retirement. That being said, there are a lot of issues with the end of life of the business, and we do want to consider those today. So I'm just going to take you through our agenda really quickly. What we want to do is cover all the key information as it pertains to Mr. LaRue and Xavier. Further, we'll go over the main issues as well as our recommendations, some alternatives that we considered, and finally what we actually decided on, what we think would be best, and then we'll sum it all up and obviously open it up to questions at the end. So, starting out now with the key information as it pertains to Xavier, we're looking at it being a CCPC that manufactures cymbals. Further, we'll look into the retirement of Mr. LaRue and what that entails for his business and where it's going to go from here. The other considerations include the tax implications on both Mr. LaRue as an individual and as a business owner. And finally, we're looking at his possible retirement project and what the profitability of that might look like in the future. So, looking now at the ownership structure of Xavier as it currently stands, Mr. LaRue owns 100% of the business and has a paid-up capital of $105,000. Looking now to the main issues that we want to consider, we're going to go over sort of the overview right now. So, we're going to consider some of the other items that should have been included in the tax payable for 2019 and determine the proper amount for that. Further, we'll look into his new business considerations and what the best option would be for him with respect to that in his retirement project. Moving forward, we'll also look at an analysis of the current proposals for the sale of Xavier and the tax consequences for the sale of business, and sort of look at three possible options with the sale of shares, sale of assets, and finally the third option that we've considered, which is restructuring the business.
Okay, so now I will begin by going through the other items in taxes payable and also calculating taxes payable. First of all, we'll discuss Xavier. So some of the adjustments we had to make based on the notes provided in your income statement was that your grandson, we had to, for the job that you gave him, we determined that it was a lot for washing machinery twice a month. So what we did is we decided to add back $11,000 in order to adjust for this and to have something more reasonable, so $4,000 of remuneration. Then also for his grandchildren, what you can't do is you can't deduct $3,000 based on music for your grandchildren because it is not a business expense. So this is why, in addition, we also added it back. Another thing is telephone nowadays is a very sensitive issue because a lot of people use them for both, especially when they're provided by the business, they're used for personal and for business use. So what we decided is to take the conservative estimate of adding back around half of your telephone charges to your executives. And lastly, another thing that was not addressed in your notes but that we saw is in order to calculate taxes payable, you need to add back half of your meals back to. And then finally, for bad debt, another adjustment that we made was that the previous years needs to be added back, and we also needed to deduct this year's of bad debt. So it was already fine. Okay, so then some other things that we will talk about was the insurance. So the insurance that you mentioned, we think there's no adjustment needed due to the fact that the payout will go to the business, not to the shareholders, so it's not a shareholder benefit. Also, the dispute with your neighbor that you needed to resolve, we consider it an ordinary part of business expense. So this is why we did not feel that an adjustment was necessary. And then lastly, the oven and windows, based on the materials that we were given, we determined that they were needed, because it said that they needed that they replaced their old windows. So if that's the case, then it's treated as an expense and no adjustments are necessary. And then finally, the penalty that was awarded based on late delivery of items, also this we consider an ordinary part of doing business in this trade. And the Congress, to the Congress for his employee, what we determined was it was basically for him to go to a engineering convention, and that he was going to gain knowledge from this that would be useful to the business. So this is why we decided to keep it as a deduction. So then finally, based on all these considerations that we made, the net additions were around to net income before tax was $21,000, around $21,000, and with the 15% tax rate that we got a tax of around $84,000 for the year of 2019. And then now for some personal issues that were also addressed in your balance sheet was the loan that was given to you for your kitchen repairs. And basically, if it was not paid in 2019, if you did not pay back to your business in 2019, then next year, then you will have to, this year in 2019, include it as a benefit. Okay, so now for your retirement, I will go through some of the questions that you gave us. So first of all, based on you asked, you decided to go with the sole proprietorship rule, and there are some advantages and disadvantages of doing this, and instead of incorporating. And one of them is this seems to be your new hobby, and incorporation could be very costly due to legal fees and a lot of bureaucracy. In addition, the profit, it's attributed to your net income right away, so you're capable of seeing it quicker. Then, in addition, you have more leniency and full control when it comes to your business. And then lastly, you have, as I mentioned before, some less legal complications. And then with the disadvantages, one of them is passing on the business is a disadvantage of the sole proprietorship due to the fact that in a corporation you're able to pass it down easier. Then in addition, in a sole proprietorship you have 100% liability. There's no way you're able to mitigate it when you incorporate, but not to the degree that you have here. And then lastly, in a corporation, you're able to defer income more easily based on several tax rules. And in a sole proprietorship, you are not given this leniency. And then some of the other questions that you had were regarding CCA. So one of the things for CCA, as of last year, November 21st, 2018, there was a new rule introduced where in the year of acquisition, you're allowed to have a CCA of 100% of manufacturing equipment. So this is why we suggest maybe, because CCA is something that you could kind of, no, it's calculated, but you could attribute to pass it down in future periods. So maybe when you have a bit more income in the future, you could decide to spread it out more. Then in addition, you asked about your consumer taxes. So the rule that we are aware of is that if you are planning or making income of over $35,000, then you should register for GST, QST. And then lastly, with your wife, one of your friends had mentioned the possibility of income splitting when it comes to corporation incorporating. But one of the things is there have been several measures that have been put in place to stop this, which such as TOSI, tax. So basically, TOSI used to apply to more children, but now it applies to spouses. So basically, the wife would have to contribute some capital and also work seriously in the business in order to be able to split income.
Otherwise, you just tax at the highest marginal tax rate, and that's really not beneficial for your just tax for the family. Yeah.
And then lastly, the last question you had was with regards to the sole proprietorship, was the renting the bottom of your basement for the business. So why we suggest the sole proprietorship is beneficial in regards to this is because if under a corporation you are not allowed to, it would be attributed as a shareholder benefit and you will be taxed more. So this is why with a sole proprietorship you have more flexibility when it comes to deductions and yes. And now I will pass you on to Carol.
Yeah, just to touch it up on a little bit on Nick's last point. So essentially, if it was a sole proprietorship, you're able to deduct sort of the maintenance expenses in your personal tax return. Whereas if it was considered a shareholder benefit, it would not be deductible by the business, and it would be an inclusion on your personal tax return. So it would be double taxed, and it's really not beneficial. So as for the analysis of the current proposals, so first we have the analysis of the sale of assets. Oh my goodness. So I understand that this portion, it's going to be pretty complex. So there's a bunch of numbers going to float on the screen. Feel free to ask me questions about it at the end. So first we basically took all the assets, and then we showed the proceeds, as well as if there was recapture, we included it in active business income, and then if there was a taxable capital gain, we included it in that column, and then we included the taxable capital gain in the CDA, and we're going to touch more upon that a little bit later, as well as we included the opening balance of the non-eligible RDTOH, and we're going to, again, touch more upon about that later. So, so this was all the assets, and one issue that we had was because the stock and the equipment were lumped together, we allocated the value, the amount given based on the fair market value that was given at the end. So about 2/5 was allocated to the equipment, and then 3/5 was allocated to the stock. So next slide, we can see here that because the business is the assets of the business is being sold, there's going to be a deemed year end, and essentially you would have to pay tax on the first fund, as well as taxes as a business on the disposition of the assets. So essentially, we would see that from the previous slide from the proceeds, you would be paying, so you'd be paying about $467,277 for the year 2020. And then, but because when you're distributing the funds to yourself, it's considered a deemed dividend, and essentially the business will be able to get a refund, a non-eligible dividend refund. And we calculated that number and we included that in the funds available for distribution, because ultimately you would be receiving that funds. So we wanted to take that into consideration when considering this alternative. So essentially we can see that we get about $300,000 of RDTOH. And the reason why this number and the RDTOH number that we calculated here is not the same is because we added the $33,000 of opening balance in the RDTOH. Essentially, ultimately, we would have about $3,500,000 of cash available to be distributed to you. And then let's look at the mechanism of how this would be distributed. So essentially, again, the $3,500,000 that's available to be distributed to you. And we have, you have the paid up capital of $100,000. So, and then you can elect on your CDA account. That's why I mentioned that a little bit earlier. We had an open balance of the CDA account. We added the CDA account for the disposition of every asset, and we basically get $701,000. So essentially, we have a taxable capital gain of almost $3 million. You have a deemed dividend, of almost $3 million. And you would have a taxable capital gain of about $100,000. So then let's look at the impact for you personally when you get these funds. So essentially you would have, you would pay personally about a total tax of $1,706,000. And if we're looking at the net tax retention, it's about $1,796,000. So if we were to consider the sale of shares, we really need to consider the lifetime capital gains exemption, because that's really important in terms of the amount of money that you're able to retain after the sale. So to be able to use a lifetime capital gains exemption, there's 3 rules. So we need to be able to, we have to own the shares of the business for at least 2 years, which you meet. There's a 50% rule where 2 years prior to the year of sale, 50% of the assets have to be used towards getting active business income, which you meet very comfortably. And finally, there's 90% rule, which is at the time of sale, 90% of the assets have to be used towards earning active business income, which unfortunately right now we're at 85%. However, we recommend paying off the shareholder loan, selling $307,000 of investments, and using that to pay off the accounts payable. And essentially, you will be meeting the 90% rule perfectly, and we're good to go. So from there, we can see that you have from the offer, we would get $3,900,000 of cash as proceeds, and then you have the ACV of $105,000. And because you took a business investment loss of $600,000, that means you took an allowed business investment loss of $300,000. Your lifetime capital gains exemption, at least the taxable lifetime capital gains exemption, used to be $433,556, but that gets reduced by the allowable business loss that you took. So now you have $133,000 available, which means that you have almost $2 million that will be included in your taxable income. And then at a marginal tax rate of 53%, you will be paying about $900,000 on the disposition, which leaves you a retention of $3 million. So we can see that from the analysis of the sale of shares and the sale of assets, it seems that the sale of shares looks a lot better as your retention is a lot higher, about $1 million higher. However, we have the final proposal, and that would be actually a corporate restructuring. So we recommend, so let's walk through the option, and then I'll talk to you a little bit about what this means for the tax payable. So currently you actually own 100% of the common shares, but we recommend to convert 99 common shares into preferred shares, and keep the final common share, and then to sell the final common share to Siljan Incorporated. And why we recommend this is actually because right now you're earning a lot of income, and when you're disposing of this company, this means that you are it's being taxed at a really, really high marginal tax rate. But because you're looking towards taking your retirement, you'll be taxed at a lower marginal tax rate in the future. And we see that you would definitely you would be traveling, or you probably would have some capital requirements as you retire. So as you retire, you can sell off portions of your preferred shares every year, depending on what your capital requirement is for that year. And you'll be taxed at a much lower marginal tax rate. So that would be exponential tax savings for you. So that's why we recommend this option.
Thanks, Caroline. So just to wrap up, we just want to go over what we recommended and what we proposed. So after going over the tax payable, again, we found that the actual tax payable for 2019 should be $83,926. Further to that, for your retirement project and looking to open up the music shop in your basement, or the music learning in your basement, we recommend you pursue a sole proprietorship for that, because it would be more beneficial than a corporation. And finally, instead of selling your business outright to Siljan, we recommend that you restructure it such that they would then own one common share and you will be remaining 99%.
In preferred shares.
Preferred shares, yeah, sorry. And that's what we have to say on that.
Now we open the floor to questions.
Speak French? Do you learn?
I can do my best.
We can do Fringlish. We can both do Fringlish.
Yes. I speak French. Pourquoi vous avez utilisé les frais de repas de 4500 meals for 1,000?
Oh,
Okay.
oh.
So
yeah.
meals.
Yes.
Okay, so so
What
you
size
pouvez,
Yeah, it's
Okay.
okay. Go back.
Okay. Okay. So for meals, part of meals is, that's the thing, because we didn't know if it was based on traveling or not. Sometimes it's with taking out clients. So that's why we made the assumption that we took, because there is a 50% rule that is only deductible. So that's why we added the 50% as kind of an assumption.
Peut-être juste une autre question au niveau de. It's about the loan yeah. You told that it was not paid in 2018. What's the consideration of this non-payment?
So
Just remember.
Okay. Okay, so it was for 2018. So the thing is, if it is not included in the year of, so basically, let's say the business gives you a loan, it's not considered a benefit unless you, when the year ends, if you pay it back, it's not a benefit. But let's say you haven't paid it back by the end of the year, then it is considered a benefit. So it will be attributed to your income, and then when you pay it, it becomes a deduction. You could deduct that, or you could deduct that.
And in which year will the Jan's?
So basically now we're talking about 2019, so if he hasn't paid 2019, then in 2020 it would be, in 2019 it would be attributed back, and then in future, so let's say when he pays it back 2-3 years later, it will be deducted then. So it kind of cancels out.
I'm just confused a little bit regarding the sole proprietorship or the corporation. So are you saying that it's better to be incorporated or to
So, no, we're saying that it's better to be a sole proprietorship. The tax rates benefit him more, and it would just require less legal qualifications, especially as it's just a retirement project. It's not meant to be something that lasts forever.
Okay, perfect.
In the analysis of current proposal, can you just walk us through how
Sure.
you
Okay.
how
Which
you
slide?
kind of just select the amount and
Okay.
stuff like that?
Which portion? Sorry.
My question is, in
Okay.
the annex one, you kind of have a range regarding the price which you
Oh, yeah.
kind of should choose. So can you just walk us through that process and how you decided to allow some money regarding that?
Sure. So because we were given a maximum and a minimum, we just took the midpoint between the two for all the assets, and then and then we use that value to be our proceeds amount for all the assets.
Okay.
Can I see option 2?
Yeah, sure. Well, yeah, let's start with option 2. Right. Yes.
This is the final price is 2 millions.
So the inclusion on his personal taxable income would be almost $2 million, and then he pays 50% of that tax, so that would be the $900,000 amount.
The buyer was l'acheteur était prêt à payer un montant de 100 000 de plus. Pourquoi vous n'avez pas ajouté à l'offre la vente d'actions?
Because it was mentioned in the notes that there are sort of contingent tax liabilities because there was an audit from the CRA, and we wanted just to make the estimates a lot, just more conservative. So it's only here, it only goes
Thank
up.
you. The question period is now over. This marks the end of your case presentation. Congratulations.